Hello and welcome to another episode of Global Business Insights, where experts and senior analysts dive deeper into the headlines. A slew of PMI, that is Purchasing Managers Index data, came in this morning. Analysts are typically of the view that PMI surveys, the Global Output Index, exhibits a higher correlation with global equity prices than, say, gross domestic product. So let's see what the figures out today are saying. Composite Stanbic IBTC PMI November, that's in Nigeria, came in at 49.6, still in contraction. Under 50 reading is contraction, but better than the 46.9 that was seen in October. The reading also expects momentum of growth in the third quarter to be maintained in Q4. We look deeper at the release later. Also in November, the German manufacturing sector remained deep in contraction territory with a reading of 43.0. That's unchanged from that recorded in October. This was as rates of decline in both output and new orders eased for the second month running, but with faster falls in employment, purchasing activity, and stocks. The November Eurozone manufacturing PMI, however, fell further to 45.2 from 46.0 in October. Also just out in the United Kingdom, the manufacturing downturn worsened. S&P UK Manufacturing Purchasing Managers Index posted a 9-month low of 48.0 from 49.9 in October. Iron ore advanced for a second day as we saw in China. The November Caixin S&P Global Manufacturing Purchasing Managers Index released, beating estimates at 51.5. The private survey noted that Chinese manufacturers saw incoming new orders rise at the fastest pace in more than 3 years, with a renewed rise in export orders. The data came after the official PMI data released on Saturday also showed manufacturing activity expanded to 50.3 in November from 50.1 in the previous month. US stock market still finished at record highs despite the holiday and half day of trading on Friday. The rally ended the month on a strong note. Dow up 7.5% in November, S&P 500 up 5.7%, and Nasdaq Composite also finished the month up 6.2%. Historically, December tends to be strong, and year to date the S&P 500 is already up 26.5%. Quite a bit of data to look out for this week. The US job openings and labor turnover survey for October comes out tomorrow. November payrolls report out on Friday, where analysts are expecting to see a recovery, a gain of 190,000. That's the November jobs after a hurricane impacted October total of just 12,000 jobs added. The unemployment rate should rise up to 4.2% from 4.1%. Will the jobs data be a reality check for rallying stocks? We have to wait and see. Stellantis shares down 8% after its chief executive Carlos Tavares resigned abruptly yesterday, just 2 months after a profit warning at the maker of Jeep, Fiat and Peugeot cars that has lost around 40% of its value so far in 2024. The company will find a replacement CEO in the first half of 2025. And still in the auto sector, this time in Germany, Volkswagen workers plan to stage walkout starting today after labor leaders and management failed to reach an agreement over how to slash costs. Swiss building materials company Holcim AG agreed to sell its 83.8% stake in Lafarge Africa PLC in Nigeria to China's Huaxin Cement Company in a deal that values the asset at $1 billion. Holcim expects the sale to close sometime next year. President Bola Tinubu leaves Paris, France, to Cape Town, South Africa today to co-chair the 11th session of the Nigeria-South Africa Binational Commission with President Cyril Ramaphosa. Our deep dive is on whether Africa could be the next Rose Garden for investors. there was a renewed build-up in new orders after a fall in October, which helped the figures. Inflation, however, remained high, not helping operations. Also, employment was down and companies reduced their purchasing amid steep price pressures. The inflationary environment and muted demand conditions meant that business activity continued to fall for the fifth month running. Sector data, however, pointed to increases in output in agriculture and manufacturing, but decreases in wholesale and retail and services. The data release also noted the apparent disconnect between the composite PMI and non-oil GDP growth in recent quarters, with this disconnect more pronounced in Q3 2024, where we saw PMI for the quarter weakened to 49.6, a sign of deterioration in business conditions, while non-oil GDP growth was strong in the review period. Still, according to the release, the Q3 2024 growth momentum is expected to be maintained in Q4, supported by festive-induced increase in economic activity and sustained improvement in crude oil production. Indeed, based on the November PMI survey results, there were tentative signs of demand improving, although customers remained deterred by high prices. Stanbic IBTC research analysts now expect the Nigerian economy GDP to grow by 3.24% year-on-year in real terms in Q4 2024 after 3.46% year-on-year in Q3. And they are also adjusting the overall 2024 growth estimate upwards to 3.2% from 3.1%, a slight improvement in outlook. President Bola Ahmed Tinubu's recent state visit to France may seem to many just another matter of diplomatic routine, but the warm welcome presents strategic opportunities on both sides as Nigeria aims to bridge trade imbalances and France needs Nigeria's vast growing markets and cheaper oil. Joe Biden also is in Angola this week, his first African visit, showcasing a US-backed railway project spanning Zambia, Congo, and Angola that the US pushed in his approach in countering Chinese influence in Africa. Many in the past have trumpeted the potential of a continent that always seems to fall short. But as we enter 2025 marked by a very peculiar geoeconomic uncertainty, Africa may indeed be the dark horse to be betting on. We keep being reminded that well over half of Africans are under 25, and by 2050, Africa will be home to a quarter of the world's workforce. But also each year, about 11 million young people are reported to be entering a labor market that's creating just 3 million new jobs per year. Leaders in Africa see that failure to bridge gaps, especially in unemployment, poverty, and infrastructure, can fuel serious social turmoil. Africa is therefore working to move faster, to woo private investment, to expand education and skills, and also nurture better productivity as it seeks to accelerate regional integration, free trade, and labor mobility. Africa is also blessed with abundant yet untapped minerals and natural resources to create new industries and markets. But there are counter forces that need navigation. First is debt. Africa is much deeper in debt today than at any time as aid drops to decade lows. Africa also has to find more money to help its poor and provide decent cradle-to-grave welfare structures as it attempts to reform much outdated tax collection practices. South Africa has long struggled with its reputation as a volatile and risky emerging market, but is now becoming a favorite among investors seeking to navigate a different world. South Africa is winning against inflation. The Reserve Bank has lowered benchmark borrowing costs twice this year, with room for more cuts. Its bonds offer some of the highest returns in the world, even as the nation moves up the credit rating scale. South Africa is a BRICS country, and US President-elect has threatened to impose punitive tariffs if they support another currency to replace the US dollar. Africa has done well in committing to strengthening trade and regional integration, but execution in trade process, the bottlenecking needs acceleration. Vast infrastructure weaknesses and political and regulatory barriers also require bolder action. Other initiatives to fast-track skills acquisition for a digital future, creation of digital and investment hubs, and bridging infrastructure gaps sees a continent waking up to new possibilities. As interest rates descend in mature markets, higher yields are putting Africa back on the investment map. Africa stands out in geopolitical stability as the macroeconomics in the major hubs, Egypt, Nigeria, South Africa, and Kenya, stabilize, and also as governance improves. And quite frankly, where else will you go? A US-China trade quagmire is set to enter another phase of disruption. We see a fresh phase of protectionism in the US. Longer range missiles are exchanged on the boundaries of Europe and Russia. Israel and Hezbollah at early stages of an uncertain truce. African nations unlikely to attract tariffs given limited trade surpluses with the US compared to, say, China or Mexico. Despite the lingering challenges, Africa must look like a rose garden. Emerging Value Insights is foreseeing that the next 5 years belongs to Africa. Watch out for quality of political leadership, areas where governance improves, improving infrastructure and macroeconomic stability, especially in vast, untapped, growing markets with rising middle-class populations. As the young population are helped to acquire the critical skills the world needs and digital infrastructure improves, the potential for very fast growth is high. The world is coming to Africa not because of a conscience wanting to be appeased. Indeed, it's for a similar reason as we saw in the scramble driven by the second industrial revolution in the era of new imperialism in the 19th century. Indeed, there are gaps today that Europe needs to be breached. Skill shortages in Europe, markets wanting better yields, and saturated consumer markets pushing new voyagers to Africa. African leaders in the next 5 years will notice a hitherto unseen embrace and must be armed with their own price list. Beyond insisting on better opening for African non-oil exports and services to improve the trading balance, Africa must be a vibrant participant in the digital revolution. Chips production and AI must not be allowed to facilitate a different enslavement. Infrastructure gaps must be bridged, and the price to enter our markets should include a steep transfer of skills and support to educate its young population. Leaders must be asking for more local value add than the West and rising Asia are used to conceding. The desired win-win needs fresh thinking that factors in a very different context. Asia Pacific stocks were mostly higher as the region kick-started a data-heavy week with investors focused on economic readings from several countries, including Japan, South Korea, and China. Over the weekend, we saw the November manufacturing PMI in China coming in at 50.3, its highest level since April. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing on Facebook, LinkedIn, X, and YouTube. And again, thank you so very much for watching. Bye-bye.